Welcome to the Me and Money podcast, where your hosts and certified financial planners, Matt Fizell and Elliott Appel, share their thoughts on hot topics, important concepts, and real-life stories in personal finance. Hear from Matt and Elliott as they share lessons learned in their own financial journeys and those they've witnessed throughout their careers while helping clients. Have a question you'd like to hear discussed on a future episode of the podcast? You can reach out to Matt or Elliott or drop your question at the link listed in the show notes. Before we get to the episode, we'd like to remind you that while both Matt and Elliott are financial planners, they are not your financial planner, and this podcast is only intended for educational purposes. For full disclosures, please be sure to listen to the end of the episode or check out the show notes on your favorite podcast platform. Now, on to the show with your hosts, Matt Fizell and Elliott Appel.
Welcome back to another episode of the Me and Money podcast. Elliott, we're just kicking off the new year. How's it going over there?
It's going pretty well over here. How about yourself?
Good. And I figured we should kick this year off with, some politically charged topics, since it's only a matter of time before the political ads start rolling again. So what do you say?
Let's start the new year off right. I'm a little scared for this topic.
All right. Well, I don't think you should be. And for those of you listening, I don't think you should be afraid of this topic either. But we're going to talk Social Security and the very publicized shortfall, the politicized cuts to Social Security. And I know you and I have been taking a look at this for our clients, but also what some of the proposals are that are out there. And there are a lot of them. We will include the link if you really want to nerd out and go look at all the things that have been proposed. I think it's really interesting.
I'd encourage looking at it. I hadn't looked at the totality of all the proposals before, and I was pretty amazed at all the things that they have studied.
Yeah. And I think it's very interesting. But if we were to summarize it into 3 buckets, and we like to do this just to help our clients understand some of the complex things that are going on, right? We always talk about the levers that we can pull.
I think before we talk about the levers, Matt, I think we should talk about what's actually in the news. Is Social Security going bankrupt?
Sure.
Let's talk about that side of it and how Social Security benefits are actually paid. Just, I think for anybody listening, when I've explained this to people in the past, they're like, oh, I didn't know that's how Social Security worked. So do you want to take the question? Is Social Security going bankrupt?
Yes and no.
Ding, 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 ding. Yes.
Yes.
Correct.
Yes, to the extent that there certainly is a deficit, right? And the reserves that you hear about on the news are depleting, but that also doesn't mean that it's going to go completely to zero, or it's not really the bankruptcy that many people often envision when they hear that word, right? When I hear the word bankruptcy, I think like the house is gone, the car is gone, I can't use
nothing's
credit
getting
card.
Paid.
Yeah, nothing's getting paid. And it's a restart at zero, right? But that's not really what they mean here. I guess if it got to zero, who knows what would happen then? But even some of the estimates out there now, they're saying if it were to go quote unquote bankrupt, or those reserves were to dry out, right, you'd still be able to pay 75 to 80%, depending on what study you're reading, for the next 80 years, is it something like that, until like 2098, I think is the last number I saw. And I always joke with my clients, especially the younger ones, like I plan on being dead at that point, so I'm not taking the it's the next generation's problem.
Someone else's problems. Let's kick this can down the road.
No, and we'll come back to that, because I'm going to say some crazy things later that I know got your head spinning a little bit. But is there anything you'd want to add to that, Elliott?
I think, just to summarize really quickly, there's 2 sides of Social Security. There's people who are paying in today, like you and me, into Social Security. And that's the part that can keep on paying benefits. And that's roughly that 75 to 80% of benefits that can continue. The part that is going bankrupt, the yes, is it going bankrupt side of the equation, is the Social Security Trust Fund. That's the one that's scheduled to deplete around 2032, 2033, depending on when you're listening to this and what the latest projection is. So I think 2032, right? Or is it 2042?
I think it's 2032.
Okay. I thought I had that right, but we're so close now. But it snuck up on me. So I just wanted to be perfectly clear of how that is actually working and how it's paying out benefits. But with that, let's continue.
Yeah. And I think we should talk about some of the reasons why, right? Maybe some things. Well, okay. I got a reaction there for those of you listening, not watching. So let's hear Elliott's thoughts on that.
Well, it's the why, right? Like for me, it's a simple but a complex explanation of politicians don't want to touch this. I mean, from my understanding, how Social Security came about to be was not this lifelong, essentially pension income source that you're getting. When it was introduced, it really was meant for old people or for people who were that word disabled or survivors, right? Like that's, if you look at the actual definition of Social Security in the program, that's what it used to come out as. And so I think it came out as that. And really, there's been some changes to the program, but not enough to make it financially viable going forward. And of course, as a politician, nobody wants to touch it because no one wants to reduce benefits, raise taxes, or do anything that's going to negatively impact someone. So that's kind of why I rolled my eyes of like, should we talk about the why? I mean, it's a politically charged thing.
Okay, like politics aside, though, like how did we get here, right? I mean, there's a couple of things that if we look at back when it was created, right, and where we are now, a lot has changed, right? Medicine, healthcare have changed. It's night and day, right? And life expectancy has increased a lot along with that. And I think that's part of when you think about, okay, well, if we're at a deficit, like what's really happening there, right? And that just means more is being taken out of the system than is being put into the system. And, I always think of it a lot like when I'm explaining the difference of life insurance and annuities to clients, right? Life insurance is a bet that you're going to die. An annuity is a bet that you're never going to die, right? Or you're going to live a lot longer than you expect. And when you think about that, right, you probably aren't going to want an annuity if you have some chronic health condition, right?
Sure.
And the reason for that is you're going to pay more into that contract than you're going to get out from it. And Social Security, with the advances in medicine and just longevity, right? We've seen it and we see it with our clients. And that's, quite frankly, everyone's number one concern is, am I going to run out of money when I'm 90, right? I think that's something where when we look at like retirement ages being increased and RMDs being pushed back, I think there is some, policy suggesting that, we need to rework how this is done, right? And I think
Matt, are you saying we should all just die earlier?
Well, that's the solution to every financial plan, right? If you run out of money at 84, you might as well just die at 83, right?
I'm just joking.
No, I like it though. But yeah, I think that's one thing, that the full retirement age, right? Like that really, in the grand scheme of things, hasn't been adjusted all too much from when Social Security started to where we are now, right?
Yeah, you weren't meant to collect Social Security for 20 or 30 years when the program rolled out.
Right. So, with that being the case, right, and I was talking about some of those buckets or the levers that we have to pull, that's really the solution to the problem, right? And I think that's why it is such a politically charged one, because your options are tell people who have been working for a long time that they can't start collecting their benefits until a later age. You're going to collect less of a benefit, or you're going to pay more in taxes. All three of those things sound awful, and there's going to be some people who aren't happy about one of those things, or probably all of the above, right?
Somebody's going to lose.
Somebody has to lose, right? But I don't think it should necessarily be looked at as a loss. And this is where, I'm all for paying the least amount of taxes possible. But if paying a little bit more in taxes for me means that I'm going to get my full Social Security benefit and I'm going to have a bigger check coming into my bank account every month for the rest of my life after I turn it on, like, what a privilege. I mean, honestly, like, let's just be
real, Matt.
Right? But I mean, that does suck, right? Taxes aren't fun. It's really, if I die at 57, like, I don't know if I'm going to sit on my deathbed and be like, oh, damn, I paid too much into Social Security. You know what I mean? So I get it, but I don't know let's just start there. Like, what are your thoughts on that? Like, outside of what people may think, and I'd be the world's lousiest politician because I think about it from every angle possible. But I guess, what are your immediate thoughts on it?
I mean, I really honestly think people are going to keep just kicking the can down the road as far as they possibly can until a decision is forced. That would be my very cloudy crystal ball because of the reasons that you mentioned, right? No one wants to tell someone who's in their 60s or 50s who are close to that age of, hey, you have to wait longer. You have to totally change the retirement plan that you were counting on. I think it's very unlikely they change it for people who are currently collecting or within a couple of years of collecting. I think that's, I mean, politically, I just can't imagine you survive that sort of thing. And so I think realistically, it's a change in taxes and or changing the structure for people who are younger, which obviously isn't going to help people who are younger because cost of living is already an issue, right? Like it's problematic any way you cut it. And I think that's my concern is there's not a good, I mean, there are some decent solutions, but there's not a good solution politically to make people happy on the whole.
Yeah. Well, I'm going to be, I don't know if necessarily the devil's advocate here. But, I always tell clients, right, you can do what you're doing now. Like, there's nothing wrong with that. It's just, we're really good at signing our future selves up for a bigger problem than what our present self would have to deal with, right? So
yeah,
it's the same concept as starting saving for retirement when you're 20 versus starting when you're 40, right? If you just contribute $100 into an account at age 20, you're going to earn more interest in that 50th year or that at year 50 of your life than you will in the first 30 years of that compounding. Like, that's how it works. And time is your ally in that case. Whereas, right, if you want to start saving at 40, you're going to have to do a much larger percentage of your income to get there. And certainly, I think we're going to get into that with some of the proposals that have been pitched to solve this deficit and this looming doom and gloom of a bankruptcy. Because there's a million different ways you could get there, right? And
yeah,
I like you, is kind of shocked at how many feasibility studies they've done, but then again, how many variants of a plan have we looked at for clients, and how many different inputs have? So I guess I shouldn't be too surprised. Maybe that was just telling what I think of some politicians or the majority of them, but. Let's
talk about some of those solutions, though, and what comes to mind, good, bad, and what percentage of that gap would it make up to make Social Security not go bankrupt, if we're going to use that language?
Yeah. So why don't we, again, just kind of approach these like by the buckets, right? Sure. So I think the most politically charged version of this is cutting benefits for existing filers. I mean, I agree with you that no one's going to survive a tax increase, but no one's going to survive taking money away from elder people, especially so. So why don't we start there and just, Elliott, I guess, why don't you pick one and talk a little bit about like what's going on mechanically with that proposal?
Just in terms of cutting benefits?
Yeah. Like why would that help solve the solution?
Yeah, I mean, very simply, it's just paying out less, right? Like we mentioned earlier, and this isn't a proposal, but it's the default trajectory that we're on, I guess, if you don't, is if no legislation is passed and that Social Security trust fund runs out and you're only getting 3/4 or 80% of your benefit, whatever it is, right? If you're getting $4,000 a month, for example, and now you're getting $3,000 a month because of that cut, well, now we have enough people, at least as of today, paying in, like you and me and anybody else who's paying FICA taxes, to support that $3,000 benefit for the person and everybody else who's collecting. So it essentially does away with the trust fund and people keep paying in. It's probably a later problem because people are having less children. So it probably doesn't, again, solve the long-term trajectory, but it at least makes it okay for today. And I'm sure that will change every single year depending on what people are making and how much they're paying in taxes. So not necessarily a proposal, but sort of a proposal in that it's where we're headed.
Yeah. Yeah. And I could see like a less extreme version of this, like rather than cutting existing filers' benefits, right? Like maybe they increase the full retirement age again, right? Sure. I don't even know what mine is. Like it's so far away. I don't frankly care. I guess I know, but I just don't know off the top of my head.
Yeah.
So I could see that. But even that, right? If they said like tomorrow, we're increasing the full retirement age to 70 immediately, there's going to be a lot of people who are 67, 68 who are going to be like extremely impacted by that. And essentially that's telling them, look, now you're going to have to work another 2 years or at least another year, most likely. So whether it's that, or I saw a proposal out there too, where if they cut, new benefits for new filers 10%, that would solve almost 40% of the current deficit, right? So that's a huge swing. Like that sounds great. But then again, if they pass that, and just based on how rapid things can change today, right? If they pass that and now all of a sudden you just got a 10% pay cut, I'm not saying it's going to like completely derail your retirement, but it's going to likely make you reconsider, right? And I think anything that comes in any of these solutions that we're going to talk about, like I think we need to say, look, we acknowledge there's a problem. We're going to start solving this problem 5 years from today. And this is how we're going to do it, rather than right. I mean, look at this year, right? We were sitting, or last year, I guess, right? We were sitting back here January of last year saying, I have no clue what the tax law is going to be January 1st of this year. And I think anytime you subject people to that extreme change and rapid change, I think it's just, we're not good at change to begin with, but when you have to make that rapid change, I think it's even less palatable.
Yeah. And for clarity, I think just for background knowledge, because I think we hear some of these ideas and we get really scared. Like I would if I were in my 50s or 60s. I'm like, hey, I'm taking a 10% cut, or my full retirement age is getting kicked out. They have changed for full retirement age for people in the past. They staggered it. And I think that's important to keep in mind, that this will change going forward. And usually they stagger it again to go farther out. And I have to step away for the door person for a second. I will be right back. And we're back to the Me and Money podcast.
That's our first ad spot.
There you go. I think to recap what I was saying, though, is they have staggered full retirement ages before and pushed it out further. So it's not like if you're 62 today, suddenly your full retirement age, if they were to do this, is likely to be 70. Likely they would say, hey, before date of birth, insert 60 and above, 55 and above, whatever it's going to be. We're going to kick this out for everybody younger than that, but we're going to maintain it for all those people that are close in age. And I think that's important to keep in mind, that normally they're trying not to affect people who have already made a plan and are close to retirement.
Yeah. Yeah. I think it's interesting, right? Because even with like full retirement age, like that's an interesting one, because how do you actually set that, right? Like what life expectancy isn't really like an easy thing to calculate in real time, right? Because who knows, we could figure out how to cure cancer, right? Or something, I don't know, like just using that as a jumping off point. And now all of a sudden we've gone from a life expectancy of 85 to 100. Like,
sure,
that drastically is going to change the math. And I think what's really interesting about this is, it really is just a giant financial plan, right? Rather than working with one person and a lot of accounts, right? We're working with one account and a lot of people. And I think that's drastically harder to like nail down and figure out how to solve this. And I think the answer is it's going to have to be multiple things, and it's going to need to constantly evolve. And like you said, that's kind of how we got here, right? Where we just haven't been willing to change, or no one's been willing to commit political suicide to get the job done, so to speak.
Yeah. Speaking of political suicide, Matt, there was a proposal that I feel like you liked, and it was more of a rip the Band-Aid off approach.
All for it. Yeah.
Tell us more.
So I think this is really interesting. Again, I'm not saying I love paying taxes, but I did see one of the proposals out there suggested a 3% increase to your payroll taxes. So I don't know exactly. I would assume it's just going to go to the Social Security tax, right? And I don't know if that was 3% total or 3% per side. It wasn't really explained, but to give you some
it was 3 percentage points total. So going from 12.4 to, and I don't know if it was 3 or 4, maybe it was 16.4. So maybe it was 4 percentage points, depending on which study we're talking about.
But anyway, so the way I look at that, right, is average Joe, right, making $100,000 a year, let's say, that means you're going to pay an extra 2% in payroll taxes on that $100,000. So that's an extra $2,000 in taxes per year. But now we've solved almost 90% of the deficit, right? I'm not going to sit here and say that $2,000 isn't a lot of money to most people these days. But again, I look at it as it's forced savings, right? And a lot of people do rely on their Social Security. A lot of people are inherently not good at saving. And I would be the first to tell you that I don't think the government uses their money in the most wise way for a lot of things. But I think Social Security is one of those few things where it does make a lot of sense. And that's because we're not good savers. And if giving an extra $2,000 a year up to get my full Social Security benefit from the day I hit my full retirement age to whenever I die, like if that's the price I have to pay, right? Let's do that. Of course, we're not going to assume any inflation or anything like that, but say you're working for 40 years, right? That's an extra $80,000 to get your full benefit. And I think you'd make up the difference pretty darn quickly. I guess the people I'd feel the worst for are business owners who are going to have to pay the extra 2% of that, right? On the employer side. And sucks to be us with the self-employed tax, right? We're going to pay both sides of it. So that's lovely. So I'll actually be paying $4,000 a year more in that scenario.
Yeah.
But I still think it's worth it. It's either that or I guess like if we want to rebrand this tax, like maybe it can be some separate new program that is
freedom
like
tax.
Sure. Isn't that an oxymoron, right? But it's one of those things where, look, if you want to call it like, I don't know, maybe they do your first 4,000 or first 2% or 4% or whatever of your 401k can actually be a Roth and you're not going to pay taxes on it. Like a tax-free, I don't know.
Making our tax code more complex, I see.
Well, sure. Why not? Why not throw one more thing in the fire? But you know what I mean? It's like, look, sure. It's forced savings. If you want to rebrand it to be something else, like go for it. If that's what the general public needs to not crucify whoever tries to get this thing passed, like that's fine. I don't care. It'll keep me employed, right? More complexity is good for my business. I don't know. What are your thoughts on that? I know you were like pretty.
I think that is a really tough sell, right? If we're taking the $100,000 example, that's, roughly $166 per month of an immediate decrease in a time when inflation's already been super high and people are already feeling cash flow issues. I think like palatably to people, they're not going to care 20 or 30 years from now if their Social Security benefit's higher because they're in pain today.
Sure.
So I think that's a really tough one, like to get by. I was reading one and I'm looking at my other screen here, and it was increase the payroll tax rate by 0.1 percentage point each year from 2029 to 2052 until the rate reaches 14.8% 2052 and later. And this one would solve the long run projection of about 47% of the issue. So not as high as yours by any measure, but I think for a lot of people, if you're like, hey, we're going to raise your tax by 0.01 percentage point, I don't know. And you do that every single year. I don't like it will make the news, but I don't think a lot of people will feel that, or it'll be slow enough that it won't be as painful. So I think that combined with something else would be an interesting proposal. That's the one that caught my eye. I mean, I didn't look through all these because there's a ton here, but that's the one that stood out to me as, hey, and a change you can make today, no one's going to like it, but it's slow enough that they might tolerate it.
Yeah, I guess, I mean, I hear that. But let's say we do this 0.1% increase, and then we get halfway into that period and we realize we're going down a very similar direction. Like, and now it's like, oh, well, it's not going to be until 14.6%. It's actually going to be until 20%, right? Like, I mean, I guess it does buy you the time to smooth it out, but I still, I don't know. It's either that, and I do hear you on that will make a massive difference to a lot of people. But I also think about the people who are well beyond like the Social Security, wage maximum, right?
Sure.
Like at least they'd be paying a lot more into the system than most people, right? Who probably need the benefits the most.
Yeah. And they've done proposals of just continuing instead of not capping the amount of Social Security that's taxable, just keep going with the wages to tax it. And I don't know what percentage that solves, but that could be in coordination with this.
Sure. And, again, I do hear you. But again, if it's 2%, like if you're really living, and this is not a condemnation, I know there's a lot of people who have like really challenging circumstances out there. So I see you and hear where you're at. But also, right, if we're living, if a 2% margin is breaking your day-to-day finances, like I think there's a bigger issue at hand. And again, I'm not going to point fingers, but it's like, look, we have $700, $800, $900 a month car payments. Like there's definitely some margin in a lot of people's budgets for $100 to $200 a month. So I don't know, call me like the brutally honest person. Like,
I don't think I will be in any position here.
No, I know I won't. That's why I just keep my mouth shut, except for on this podcast. But I don't know. I think that's, and I only say that because I know the people who would be upset about giving $100 to $200 a month are going to be really upset when their benefits get cut $500 or $600 a month in retirement. Sure. And so that's the way you got to look at it. I look at it as just a forced savings vehicle. And I think if we can just look at that specific tax, right? If we're going to talk about state taxes and property taxes and other federal income taxes, like I'm all for cutting those, right? But it's one of those things where I think this is one of the few things that actually helps more people and is generally overall like plus when it comes to taxes. And is like, I don't know, you could say it hasn't been well governed or stewarded, but I think it's more of a systematic issue.
Yeah.
All right. What else, Elliott? So we did extend or cut benefits. We started talking about increasing taxes. What other ideas are out there?
I mean, these can probably fall into the other categories, but you could change cost of living adjustments. There's proposals around that, but that's essentially changing benefits at the end of the day. You can get really, or slow the benefit, or, slow the cost of living adjustment. So different ways to structure, but it's all under changing benefits or changing taxes, really.
Yeah. Well, other than just like changing the tax rate, I guess, like what are some other proposals that would be a technical increase in taxes, but aren't just a flat percentage to everyone? What are some other proposals out there?
I mean, I mentioned it, but basically Social Security's wages are only taxed up to a certain point. So you could continue to tax above that. That'd be sort of like a high income earner tax. You could, theoretically, I guess you could increase the tax on certain wages above a certain amount.
Yeah. I have one other thought.
Yeah.
And this
please.
This is like kind of out there, so we'll see if this makes it into the episode or not. But it's funny that you brought this up the other day, because someone at a conference a few years ago now had asked a group of us at dinner. There were like 10 of us there. Like, what would you do to fix Social Security? And that was a really fun, like, thought experiment when you have 10 super analytical, very talented financial planners who were just kind of riffing on their idea. And of course, you got like some comical ones that I won't repeat here because probably would need the explicit tag for sure. But, you know, I thought it was interesting too. Like, what if they recalculated like some of the taxes in retirement of, like we have adjusted gross income and we have modified adjusted gross income. Like, what if there was some form of that calculation that would like either increase more taxes on the Social Security benefits to bring the money back to the people who quote unquote need it, right? Or if there was some threshold where, after you have X amount of dollars in your accounts, right? Because the government knows that already. Maybe you just get partially phased out of your benefits instead. I thought those were both like really interesting ideas. I don't know how that would go. I think that would get really complicated. And again, we're kind of getting into benefit reduction here, but I've also seen it, where people have more than enough money and they don't know what they're going to do with it. And they're still collecting Social Security. And again, I'm not saying that's a bad thing because you probably worked hard and rightfully earned that money and made good decisions. But what is the spirit of Social Security was my question, right? So I'm curious what your thoughts are on that.
They've certainly talked about means testing it. I think you're going to have a really hard to impossible time doing it based on account balances, similar to ACA credits and healthcare premium tax credits that we talked about in the past. And those are in the news a lot. But, they do that based on income because they don't really have a way to easily track, Matt, your net worth and the next person's net worth and all that. So I could see it at some point being a income thing of, hey, if you have income above a certain amount, your benefit gets reduced XYZ or whatever, almost like a, different tax credits. If your income's high enough, you don't get that tax credit. So maybe there's a Social Security tax credit in a way. I mean, we're just making our tax code more complex, but you get the picture.
Well, so I guess where I was going in with this, and I just kind of danced around it. I didn't want to say it outright, but like with a skyrocket in popularity for Roth conversions, right? What are your thoughts on like if they included Roth distributions, not as a tax, you're not going to get taxed on those, right? But like, what if that gets factored into that calculation? Like, what are your thoughts on that?
I mean, you sort of put me on the spot here, but I'll go with it. I think based on my understanding of the tax code, there's not a ton that Roth distributions today affect in terms of changing your taxation or qualifying for benefits. And I say that only because I think it's sort of an implicit thing by the government to say, hey, once you've paid that tax, we're not necessarily going to punish you, right, for taking this money out. And I think if you were to take money out of a Roth IRA and count that into more of your Social Security being taxable or not getting as much Social Security, you sort of implicitly broken that, which it's not to say the government hasn't said in the past, hey, we're going to break some of these implicit guarantees we've had in the past. But I think the more you get away from your general tax code and what's been promised and sort of what's been implied, I think people lose trust in the planning process and government and all of that. So that scares me a little. I would rather see more of a vanilla plain, like let's increase taxes a little bit or kick out the floor things that they have done in the past that for me make more logical sense than let's introduce this new complexity.
Sure.
That's kind of where my mind goes immediately, but
no, that's fair.
I don't have fully formed thoughts on it.
And it was really just a thought experiment, right? Because it is a tax, right? Like it's so fascinating to me, like how a tax is framed or positioned can really impact the willingness of people to pay it, right?
Absolutely.
And that's more of what I was driving at with that. So to me, it sounds like maybe like you didn't like the idea of more payroll taxes, but you really don't like the idea of messing with how that Roth would contribute to that. That's really all I was searching for there.
Yeah. And I think that's the case. Like anytime that you have something that is not normally affected in the tax code, but then suddenly affects this other thing, that to me, like, and there's a few examples and I'm drawing a blank on them, but sort of like the calculation of the taxability of Social Security, some income is included and some is not for that calculation. That becomes very complicated. And I think just, again, like our tax code's already complex enough. Why are we introducing one more layer and one more technical definition that most people aren't going to understand, and that I myself have to go back and remind myself, oh, what am I including in that when I do those calculations to make sure I don't run afoul of something? So that's, I mean, I would love to see a simpler tax code, I think is the heart of my thoughts here.
Yeah, I'm right there with you. And the easiest way then to solve it is to just increase payroll taxes by 2%.
Or kick out full retirement, like some combination of all these, right, that they've done in the past.
Yeah, but even with the full retirement age, right, that gets complicated too, because it's going to be like everyone's in a slightly different boat. I don't know.
Yeah, I think that's
now I am playing the devil's advocate.
Yeah, like they've changed R&D ages the last couple of years, right? Going 70 and a half to 73 to then 75, depending on your date of birth. Same thing applies for Social Security. I don't think that they kicked it out in the past though. So it was like 66 in 4 months, 66 and 6. Like, I don't think we need to get that granular. I think you just, I think you can rip the Band-Aid off a little bit, particularly if you start it young enough, right? I think it'd be very reasonable if you're like, hey, for us, maybe full retirement age is 69 or 70, right? As opposed to 67.
Sure. Yeah. So it sounds like if you could only pick one solution, which one would you pick?
No, I wouldn't pick one solution. I'm going to be a politician here and straddle this and say, I think increasing by a tiny amount.
No, that's not
year.
A politician, Elliott. Our politicians go all in on one thing and one thing only. That's what they do.
Kicking out full retirement age and then whatever else. I don't know. I think it's tough because you don't want to change someone's plans close to retirement, but also do you want to put all the burden on people who are younger? And that's sort of a philosophical question.
Sure.
More than anything there.
Fair enough. All right. Well, this was a fun one to debate. I'd love to hear the listeners' thoughts on this, so please comment on the videos on YouTube or shoot us an email, which are in the show notes. And we'll put the link to all those Social Security proposals in the show notes. Yeah.
I'm sure this will get some great comments. This is always a politically charged. I'm sure people will say we're totally wrong and we're idiots, and we'll see what happens. So let us know.
Yeah. Freedom tax, though. I like that one, Elliott. A new tax, the freedom tax.
There you go.
Elliott Appel, signed. All right, Elliott. It was good to see you.
Likewise.
Thanks for listening to this episode of the Me and Money podcast. We hope you enjoyed the show. Have a question you'd like to suggest for a future episode? Drop Matt or Elliott a question at their email or use the linked form in the show notes. Like what you heard? It would be a tremendous help to us in our mission of having real conversations about personal finance by leaving us a review on your favorite podcast app. A few words can go a long way in connecting those looking for content like ours on their app of choice. You can also support the show by liking, sharing, and subscribing. Thanks again for listening, and be on the lookout for future episodes soon.
The Me and Money podcast is hosted and produced by Harmony Outsourcing Services LLC. Matt Fizell is an investment advisor representative of Harmony Wealth L.L.C. Elliott Appel is an investment advisor representative of Kindness Financial Planning LLC. However, the views and opinions expressed by Matt and Elliott in this podcast are not intended as individualized investment advice on behalf of Harmony or Kindness, or as tax, accounting, or legal advice. Although we gather information from sources that we deem to be reliable, we cannot guarantee the accuracy, timeliness, or completeness of any information prepared by any unaffiliated third party. When specific investments or types of investments are mentioned, such mention is not intended to be a recommendation or endorsement to buy or sell the specific investment. Harmony is a registered investment advisor authorized to do business in the states of Wisconsin and Texas and other jurisdictions where exempted. Kindness is a registered investment advisor authorized to do business in Wisconsin and Washington and in other jurisdictions where exempted. Registration as a registered investment advisor does not imply a certain level of skill or training. This website contains links to the Harmony and Kindness websites that provide general information about the advisory services offered by Harmony and Kindness. These links are provided as a convenience only. Harmony and Kindness can only provide individualized services after you sign an agreement and receive required disclosures. Users of this website may, but are not required to, engage the services of Harmony or Kindness for advisory services. Please remember that all investments involve varying degrees of risk, and the future performance of any specific investment or investment strategy is not guaranteed to be profitable or equal to any historical performances. As a final note, we'd encourage you to reach out to your financial professionals before implementing any of the strategies or concepts discussed in this podcast. Thanks again, and we'll see you next time.